Iron ore is entering its bull quarter, so we're going to look at what that means from an investment point of view. We have a community question around chess v custodial models. Yes, we are returning to debate it once again. And we're going to close out with a monthly review of our portfolios, how we've been performing year to date and over the past month. Make sure you stick around. Welcome to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. There's a lot happening in markets, but I'm also a bit nervous because, we want to be transparent. We want to be as transparent as possible, and that includes sharing our portfolios, every holding, what we're buying, what we're selling, and we're doing that in this episode. And as we prepare for that, I always wonder, what if I've just got a terrible investment decision hidden in there, waiting to blow up in my face?
You're looking forward to this one. I know you are.
No, because that's all past. It's all about the future. But we're going to do it.
We're going to do this more often. I think we will commit to trying to actually talk about it once a month.
Yeah.
And really show people what's going on, because I think the next few years, particularly as we explore more and more of what's going on in the world of investing, we're going to be more and more active with our portfolios. And
oh, interesting. I was actually going to say the complete opposite as well.
Really?
I was going to say we're going to do it monthly as a reminder that core portfolios get set and then don't really change over time.
That's core, though.
Yeah, okay. Well, yeah.
We'll be talking about, you're just not going to talk about your satellite?
No, I will. But I think, every month I want to be like, here's the core, here's how it's gone, same holdings, dollar cost averaging. I'm not searching for the fifth ETF.
Absolutely.
That's enough.
Yes, yeah, absolutely. All right, well,
we'll get to that segment later.
That's segment number 3. Plenty to get stuck into, so let's do it.
News and markets.
Ren, iron ore is entering its bull market.
Yes, Bryce, it is.
No, sorry, not bull market, bull quarter.
Yeah.
And we want to have a look at it because there's obviously correlation between what it does and then what some of the big miners do in terms of their share price.
Yeah. Now, look, this is data that I wasn't familiar with, and a hat tip to Market Index who did the work here, and we're just riding their coattails. But I think the context here is that the Australian market rides iron ore in a big way. Australia used to ride the Shapes back. Now we ride the Chinese steel mill demand. Not as catchy. Now we ride the iron ore shipments from the Pilbara to China. And it's really headlined by Australia has 3 of the big 4 iron ore miners globally. Rio, BHP, Fortescue, and then Brazil's Vale rounds out the top 4.
Yeah.
And they've had a mixed year. They've actually been all right recently. I think they were all up double digits for the year, Rio, BHP, and Fortescue. But they were down earlier in the year. There wasn't a lot of love for our miners in the first half of 2025. This data piqued our interest, and it has looked at iron ore prices from 2015 to 2025. So for the past 10 years, and it's tracked their monthly movements. And what it has found is that November to January can be seen as a bull quarter for iron ore prices. It's looked at the average and median price move in each month for those 10 years, but then also the percentage of times the iron ore price is positive. It goes up in that month. And throughout the year, it sort of oscillates between 36% of the time positive to 64% of the time positive. So range bound in the middle. Then you hit November. 70% of the time of the past 10 years, the iron ore price has been up. December, 90% of the time, the iron ore price has been up. And then in January, it falls back a bit. Again, 55% of the time, it's been up.
So, Ren, also just looking at it, it's not just the consistency at which there's a positive growth. 90% in December is wild. It's the size of those moves as well.
Yeah.
So if we look at across the board, the median is pretty flat. I mean, maximum between sort of February and November is about 3%. But then November, December, you're looking at a 6% increase, and then December, 7.5% increase.
Yeah.
So pretty significant difference between that quarter and the remainder of the year. What is going on? China just love buying in December?
Well, there's 2 things. So Market Index point to peak construction period in China is between March and June.
Okay.
And so the steel mills are loading up.
Yeah.
But I remember back from my days working in the waste industry, where China is such a giant global player, Chinese New Year is just massive. Because everything shuts down. Like you would remember it from your Woolies day, trying to get product out of China in late February is just a nightmare. Yeah. And so
they're front loading.
Yeah. So Chinese New Year is mid-Feb. And so they load up, obviously, to make sure they have the stock.
Yeah.
So then they can process it, get through Chinese New Year where they shut down, and then they can service demand in peak construction period.
Wow. And then immediately following New Year, you have not necessarily a drop, but a slowdown in the price.
In the iron ore price, yeah. So that's obviously, like, we're not mining analysts. There are people far smarter than us doing this work. I mean, we are just writing work that someone else has done in this segment. But I just found it fascinating how stark the move was in November and December. And for our iron ore miners who are recovering and have had pretty good second halves of the year, the iron ore price is ticking up, they may be in for a really good November and December if this trend holds.
Yeah.
So then Market Index took it a step further, and BHP and Rio are more diversified mining giants, whereas Fortescue is really a pure play iron ore company. So they looked at how the Fortescue share price tracks the iron ore price. And what they found is that, I mean, particularly in December, it's a good month for the Fortescue share price. 80% of the time over the past 5 years, it's been up.
10 years.
Sorry, 10 years. 10 years. Yeah.
Okay, so long Fortescue.
Well,
Christmas present.
I mean, like, we just wanted to share this data because we found it interesting.
Yeah,
but
it's pretty interesting.
I think it'll be worth watching to see how it closes out the year.
Yeah.
So, 80% of the time in December, Fortescue is up, and then 73% of the time in January, it's up. But then you can see the bull quarter ends, and then February and March,
get out.
Less than half of the time, Fortescue has been up. 46% in February and then 46% again in March. The share price has been up, so the majority of the time it actually has been down in those months.
There you go. What did they say? History doesn't repeat, but it often rhymes. Is that the saying?
Yeah.
Nice.
Yeah,
nice.
So, I mean, hopefully, for people who aren't particularly interested in mining and have somehow slogged their way through this segment, this will still be good for them because, you know, Rio and BHP and Fortescue all having good months will hopefully drift the ASX 200 up, which is up double digits this year. Has lagged some of its global peers. So hopefully it's a nice little Christmas present for us all.
Love it. Well, if you want to keep up with all of the news, make sure you subscribe to our daily newsletter and our daily Headlines podcast. It's called Headlines by Equity Mates, available wherever you listen to your podcasts. We send you a dot point summary of all of the important news headlines from around the world.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, I've got a question.
Answered.
Chess v Custodian, the debate that we often see happening among community members in the Equity Mates group, one that we don't often regularly visit ourselves, but we do have 2 community questions that have come in today, so we thought that it would be a good time to jump back in.
Yeah, so the first question comes in from Jess.
Hi boys. I started investing after I started listening to your podcast earlier this year, so a big thank you. Since April, I have 10k invested in Sharesies across mainly core ETFs for my core portfolio, along with some thematic ETFs and a small satellite portfolio which is made up of direct shares and a little bit of Bitcoin. I can invest regularly about $600 a month, plus some extra money as it becomes available for my tax returns and birthdays, and I've been stuck on whether I should keep using Sharesies as a custodian model or move to stake because it's Chess sponsored to keep building my core portfolio, which I plan to keep in the market for as long as possible. I would love your advice on what you think about using a custodian model versus a Chess sponsored model, and what would happen to my shares if a company like Sharesies went bust. Thank you.
So much positive stuff there from Jess, to be honest.
Yeah, well done, Jess. But we'll answer your questions after we also hear from Tim.
Hi guys, love the show. My wife and I started our investment journey a year or so ago on a particular platform, and we're now considering changing platforms and have a question on which model is better, Chess or the custodian model. Our current platform is a chess-based model, but my little play on the side portfolio is a Custodian. I'm pushing for the Custodian model. I'm not really sure why. Would be keen to hear your thoughts either way. Cheers.
Well, first of all, thank you to Jess and Tim for the question. If you want to ask a question, head to equitymates.com/contact. We love it if you leave a voice note. Now, second of all, Bryce, put your armour on. We're wading into this debate.
We are.
Turn notifications off on the Facebook discussion group because the debate will continue there. If you want to join the debate, head to the Facebook discussion group. Where do we want to start?
Let's start by defining what both of the models are.
Perfect.
So let's just start with CHESS. So CHESS is an acronym. It stands for Clearinghouse Electronic Sub-Register System. It's the official system that is used by the Australian Securities Exchange for settling and recording all of the shareholders that buy through the Securities Exchange.
Yeah. So you get a holder identification number, a HIN, and the ASX record the shareholding against your HIN. So they're held in your name.
Yeah. So that's the CHESS. So the alternative model is the custodial model, which is held by a licensed financial institution. They are the custodian on your behalf.
Yeah.
And so they pool investors together on one HIN.
Yes.
And then that is what is registered. So you retain all beneficial ownership of your investments, dividends, interest, capital gains, you name it, but it is just held by the custodian rather than against your specific name.
Yes.
That's it.
That's it. Now, let's talk about the advantages and disadvantages generally. Let's quickly rip through some of them, and then let's share our opinion.
Sure.
Okay.
Yeah.
So the advantages of CHESS is it's the highest security since the assets are legally held in your name. Even if a broker or a custodian falls, they're still held in your name. You have voting rights that you don't normally get with a custodial broker, and it is sometimes easier to transfer shares between brokers if you want to move.
Yeah. You can set up dividend reinvestment plans.
Oh, that's an important one.
Directly through registries if you are CHESS.
Yeah, that's an important one.
Yeah.
So then the disadvantages of CHESS is generally higher cost.
Yeah.
It might only be a couple of dollars brokerage, but generally you're paying a little bit more. Definitely a disadvantage in my mind, more paperwork.
More paperwork.
The amount of letters that you get, even if you tick, don't send me letters, you somehow still get letters.
Yes. All right, well, let's move to Custodian. So advantages of Custodian is you'll see a lot of the lower brokerage online platforms using that model because it is cheaper to run it that way than it is to go through CHESS. You can do fractional investing because you pool all of your money together. These brokers can offer fractional investing, which I think is pretty advantageous if you're doing small dollar investing. Less paperwork. None of the paperwork comes from the ASX. It's all handled by the custodian. It's suitable for micro investing because you don't need to do the $500 minimum that is imposed by the ASX and the CHESS system.
Yeah.
So those are the advantages. Disadvantages of the custodian model: less direct control and ownership. As we'll get into, there are some issues if the custodian fails, but we'll chat about that in a moment. You lose all your voting rights, and porting between brokers sometimes can be a little bit trickier, and you cannot set up a
Dividend reinvestment.
Yeah.
Or at least you can't do it through the share registry.
That's right,
Some brokers will offer a dividend reinvestment function on the brokerage platform.
Yeah.
Okay, that's the high level advantages and disadvantages. Let's get to our view. My view, this is such a niche Australian conversation.
So ridiculous.
The rest of the world is custodian. If you are buying a US share, you're embracing a custodial model. Managed funds, custodial model. Your superannuation, custodial model. For all the CHESS zealots out there, I would look at their portfolio and say that in some way, shape or form, they are forced to embrace a custodial model. So for me, this isn't even a question of how I should be investing. This is a question of how should my sleeve of direct Australian equities and ETFs be invested. And that's why I kind of get sick of this conversation because at some point in our lives, our investing lives, we are all embracing and accepting the custodial model. And so it's just to what extent do you accept the custodial model?
Yeah.
No one's pure play chess.
No one's pure play chess.
Unless you just own Aussie mega caps.
Yeah. Now, I think the biggest question, though, that people often get to is like, oh, but I'm going to lose my shares if the broker goes bust. So in this instance, I think it was Tim who was talking about, not Tim,
Jess.
it was Jess who was talking about sharesies. Now, the broker can go bust, like, sure, that is a possibility.
Yeah, they're all, a lot of them these days are startups who are raising money and trying to build a business and trying to make the economics work.
Exactly. Yeah, like it can go bust. However, you're not going to lose the money because the broker is not holding your shares.
The broker isn't the custodian.
The broker is not the custodian. Yeah. Exactly. It is the custodian that is holding your shares.
And the custodian is like Citi or State Street or like some of the biggest institutions in the world are the custodian.
Like too big to fail institutions with an asterisk. But like,
wait, what's the asterisk?
Like, well, you can never say too big to fail, but like so big that sure, if Sharesies go bust or if Superhero goes bust or whoever is the custodian, your shares are still registered and held on your behalf with that custodian. You need that custodian to go bust for shit to really happen. So it's just not worth worrying about, in my opinion.
And that is the comment that gets clipped and then people go for you.
Well, like people spend so much time and energy debating this and like worrying about which one to start with. And like at the end of the day, as you've rightly pointed out, Ren, so much of your wealth is tied up through superannuation in a custodial model and you're not doing it and you're not fighting that.
Yeah.
So like if you're happy with that and that's being tied up for 40 years, don't waste time and energy on this.
Ironically, a lot of the time, depending on your broker and your super fund or the managed fund that you're investing in, they could be the same custodian.
Absolutely. Yeah.
I mean, in some instances, like if I was to probability weight the chance of State Street falling over, a multi-trillion-dollar global asset manager, or the ASX falling over, the way the ASX has gone recently.
I know.
But look, I know, like we're kind of being flippant, but it is something that we get a lot of questions about. I think it would be probably the most frequent question we get here at Equity Mates is what broker should I sign up with?
Yeah.
And the way that we always like to answer it is that brokers will differentiate on different features. They will try and attract different investors. They will have different offerings. But at the end of the day, what you're investing in is the same. Whether you're buying BHP through BetaShares Direct, through Stake, through Superhero, or through CommSec, either way, you're buying shares in BHP. There's no half price on BHP shares if you buy it through BetaShares Direct. There's no double dividends if you buy BHP through Stake. They are offering you access to the same thing. And what matters is not the platform through which you buy it, it's the investments you make and the investments you keep making. And so I think be confident that whatever choice you make, whichever broker you sign up with, as long as they're an Australian regulated broker, is better than making no choice at all.
Absolutely.
Because the worst thing to do is you get frozen at this stage, you get analysis paralysis, and then you spend so much time trying to get the non-important decision right, which is the platform I invest, rather than focusing on the important decision, which is investing and investing regularly.
Yeah. So Tim and Jess, thank you so much for your questions and for getting stuck into investing and thinking about the setup of your portfolios. We love to hear it. And we should say, Ren, to close out, we both use multiple brokers, a mix of Custodian and Chess.
Yep.
So there's no right or wrong here, and you can pick and choose and move between brokers pretty easily these days. So don't feel like you're locked in either way.
Choosing those multiple brokers, Chess or Custodian, was never the first consideration for me.
No, still not a consideration. All right, we're going to take a quick break, and on the other side, we're going to look at how our portfolios have been performing over the last year and over the last month. So stick with us. We'll be right back. Welcome back to Equity Mates. We are kicking off our monthly portfolio review, something that we're going to hopefully take into 2026.
No, we will.
We will take it into 2026. All right, Ren. So we both use ShareSite, we should say, and it's an awesome platform. If you want to actually use ShareSite, you can head to sharesite.com.au/equitymates and you can sign up and plug it in. The reason we'll like it, and if you're watching on YouTube, is the reporting functionality is fantastic and allows us to track all of our investments across the many different types of brokers that we've used. Just came off the segment around brokers. So this pulls it all into one view. So what we're going to do today is a high-level breakdown of everything that is going on in our portfolios, core and satellite. But for a full, detailed breakdown, all of our core portfolio positions, all of our satellites, the thesis behind them, how they've been performing, tune in next week on our YouTube channel where we will go deep on everything. All right, Ren, well, should we start with year-to-date?
Yeah, or do you want year-to-date or inception? Yeah, we'll go
year-to-date.
Okay.
Year-to-date. Year-to-date core, start with there. So I guess for context, we both run core and satellite portfolios.
Yep.
If you've just joined us for the very first time, simply a core is a makeup of either one or multiple low-cost index ETFs that give us broad exposure around the world. And then that is complemented by a number of individual stocks and active managers to try and, I guess, beat the performance of the core. All right, core, since the start of the year, so mine is made up of 4 ETFs. We'll go through each of them in detail on our YouTube channel next week. But total return for the year, Ren, has been 22.53%.
Nice. Okay. So yours has outperformed mine. Mine has been 16.7%. And I think when we talk about the makeup of our cores, people will start to understand why. So we each run 4 ETFs that track respectively the US, Australia, Europe, and Asia ex-Japan.
Yeah.
The Europe and Asia ex-Japan ETFs are exactly the same and have actually both done really well.
Done really well.
Both Europe has done 20.4%, Asia ex-Japan 25.6%.
Yeah.
But the difference comes in the US and Australian exposure. Same underlying index, ASX 200 and S&P 500. You just have a leveraged version of that.
Yeah.
So why don't I say, let's start with Australia. My Australian ETF year to date has done 12.3%. What's
Australian?
Yeah.
Yeah, so this is the big divergence, 27%.
Oof.
Yeah.
That's leverage for you.
Yeah, that's leverage.
Okay, and then my S&P 500 US ETF has done 10.6% year to date.
Yeah, so GJUS is 19.19.
Yeah.
Yeah. And that's hedged as well, so that's taking out any currency fluctuations on the US side. So there you go. I mean, that is clearly the difference between hedged and
leveraged.
Leveraged and non-leveraged. Keep in mind though that it does swing the other way just as drastically, but that is the outperformance.
So let's get to satellite. Now I run a bit of a split satellite portfolio, so maybe for cleanliness, why don't you kick us off?
Okay.
How's your satellites gone?
So I just bucket everything else in
satellite.
Yeah. We'll probably clean it up as we progress into next year. But I have a mix of crypto, individual stocks, and thematic ETFs. Mm-hmm. We'll go into detail in YouTube on what they all are. But in total, I've got about 9 positions, including an active manager. Total return year to date has been just shy of 21%, 20.53.
Nice.
So I actually haven't outperformed the core.
True.
Yeah.
That's leverage for you. What's been some of your best performers year to date?
So the Global X Semiconductor ETF, just shy of 41%. Supermicro, 38%. Alphabet, which I've actually sold a lot down, but still holding a bit, is 35%. Shouldn't have sold that. So yeah, those have probably been the top 3 performers. Worst performing has been Berkshire of all companies. It's delivered a 2% return. Big drag on currency, but again, we'll go into detail on YouTube.
Nice. Above 20%, that's great.
What about you?
So
you're in the 70s?
The way I do it is I split individual stocks and then active managers as like 2 separate portfolios in ShareSite, because you can set up multiple portfolios.
So good. So
I'll start with my active managers. Overall year to date, it's actually been pretty bang average, 8%. There's 2 thematic ETFs. Hack has returned just shy of 15%. Global X Semiconductor, 42.5%. Not bad. Then I've got 5 active managers. Munro Global Growth has done 16% and Hyperion has done 12.5%. So pretty happy with those. Fairlight, who we both invest in, is actually basically flat for the year.
Yeah.
The global small cap fund. So look.
So much for the year of small caps, honestly.
I know. It's a year of mega caps.
Come on.
Honestly, that's a pretty disappointing drag. Active managers sell themselves on outperformance. My thematic ETFs have done better than my active managers. My active managers have been pretty average. But importantly, overall, that sleeve of my portfolio, delivering 8%, is less than half my core ETFs, my index tracking ETFs.
In terms of weighting.
That's done, that's have returned 16.7%.
Oh, I see what you're saying.
Yeah, in terms of weighting, they're smaller as well. But it's just, again, a reminder that active managers struggle to beat the index. And it does make me think about their place in my portfolio going forward.
It's so hard to know, isn't it?
Yeah. So that's my active manager and thematic sleeve. Individual stocks, 23.98% so far this year. Yeah.
Nice. Roughly how many positions?
1, 2, 3, 4, 5.
Here we go. Because Ren's got to count about 120 positions.
18.
Okay.
Yeah. I actually sold some recently, and really annoyingly, some that have done really well.
It's always the case.
So, like I sold BHP, and then it's run since.
Always the case.
Sold Google.
Yes.
It's run since.
I know.
Don't you were really giving me grief about
that.
having too many positions.
Yeah.
But in terms of best performance this year, Jumia has done 180% this year. Coinbase, since I bought it, just shy of 100%. Catapult, 97%. Shopify, 56% this year. So there's been some good performers.
And I guess if there's a reason to listen to Equity Mates, all of those stocks we've spoken about on Equity Mates.
So. Well, I mean, we talk about our whole portfolio.
Get around it.
Axon, which is my biggest position, has done 19.5%. Yeah, there's been some good ones. Like Spotify has done almost 40%. Transmedics, which you brought to the table, has done just shy of 40%. C Limited, just over 40%. Big drags on my portfolio, WiseTech and Novo Nordisk.
Yes. Yeah. Well, there you go. So high level, you can't complain with 23%, roughly 20% as well. Certainly beating the index nonetheless.
Yeah.
Compound that over 40 years and we will be very, very happy.
Yeah, but also just like a reminder that the index doing 16.5%, well, my blended index portfolio doing 16.7% a year. Put that in a compound interest calculator over 35 years.
Big time.
Yeah.
For a detailed breakdown of everything in the portfolio, we'll talk about the thesis behind some of them and maybe perhaps what we're looking at buying as well. Tune into our YouTube channel from next week.
Yeah. And we'll also talk about maybe returns since inception.
Ren's desperate to
have a look at that?
Ren's desperate to get that out there. So we will talk about that. But otherwise, we'll be back next episode.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.